Welcome back, class, to another week. Fortunately, this week is going to be our last week. So today is going to be our last lecture, and I do hope we will be able to finish what we have in mind of actually doing today. Today we are going to do two topics. The first one is to look at issues on national income, and the last one is to look at issues on the fiscal sustainability and debt restructuring process. So let's just begin. So when you look at our first topic, we are going to look at what is the national income.
And it's the same thing with my sisters. The same thing.
Okay,
So
so
that's like
let
I'm always
me.
saying sometimes. What is the issue? What is the gap? What is the cause?
Okay, so I've muted and done it. Okay, so we are going to look at national income and what is so this is actually the macro side of it. And what is the national income? We basically going to look at issues on the GDP. So in terms of the national income account, and we are looking at how the composition of GDP is done. And when you look at the composition of the GDP, it comprises of several issues. At the macro level, for instance, we are looking at issues at the macro level. And at the macro level, we are looking at something that affects, okay? We are looking at something that affects the entire economy, not just an individual unit, not not just not just an individual unit, not just an individual unit, not just an individual unit. When you look at the previous topics that we've always been doing, we've been always been looking at demand, we've been looking at supply, we've been looking at market structure, we've been looking at costs. Those ones are the micro level activities, okay? Because they affect an individual, or they affect it leads to an individual, or it leads to an individual as a person, or it leads to firm units. But for issues on macroeconomics, we are looking at something that affects the entire, economy. So when you look at those key variables that affect the entire economy, for instance, if you pick something like inflation, if you pick something like inflation, which is looking at the general increases in prices of goods and services. This level of inflation is macro in nature because it affects the entire economy. When you also look at issues on national interest rates, it is also a macroeconomic variable. When you look at issues on exchange rates, it is also a macroeconomic variable. When you look at something on GDP, this we'll be talking about more in today's lecture. So all these things are things that we call the macroeconomic variables, things that we call the macroeconomic variables. And these macroeconomic variables are variables that actually affect the entire economy. So, for instance, you cannot have at the macro level, you cannot have maybe inflation for only maybe you as a person, maybe inflation for maybe the cost, like maybe Andani, or inflation for Humu, or inflation for maybe Asia, or inflation for Abu, inflation for Kofi. No, if it is an inflation rate, it's an inflation rate for everyone. If it's an interest rate for everyone, exchange rate for everyone. So these are basically key macroeconomic variables that we are going to look at. But for today's lecture, we are going to concentrate on, like I mentioned, on issues of what the GDP, on issues of the GDP. And we measure GDP using what is called the national income accounting, using an approach called the national income accounting. Now, if you pick Ghana, for instance, if you have this as the map of Ghana, people are here producing. People are here, people are here, people are here producing. So whatever that is produced here, they are all produced within Ghana. They are all produced within Ghana. So if you pick here as Ghana, they are all produced within Ghana. Okay. And inside Ghana, we have both citizens. We have both citizens, and we also have we have foreigners. And all these guys are in the country producing, contributing to the economy. So they provide their goods, all these guys, citizens, and then foreigners, they produce or provide services. So here they engage in production of what? Goods, production of goods and services. So all the foreigners that you find, the Chinese, the Lebanese, the Indians, whoever who is in Ghana producing, they contribute to Ghana's goods and then what? And services. Now, when you put everything together, all the production of goods and services, okay, that are actually done within the four walls of the country, here, 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 within the four walls of the country. All those production of goods, all those services that are being what offered, when you put everything together, okay, you will get what is called the GDP. So the GDP of a country refers to the market value, of all goods and then what? Of all goods and services produced within a country, of all goods and services produced within a country. Here, irrespective of what? Of who produces it. Irrespective of who produces it. So here the focus is on irrespective of who produces it and the production of what? The market value of goods and then what? Services. Here it is irrespective of who produces it because as a country we have foreigners who are also production agents, and then we also have what? Citizens. So as far as that particular good is produced within Ghana, we will count it as part of our what? Our GDP. And the GDP, the full meaning of the GDP is called the gross domestic product. The full meaning of GDP is the gross domestic product. Is the gross domestic product. So whatever that is being produced in Ghana, we look at the market value of what is produced in Ghana, and then we sum all of them to get what is called the gross domestic product, to get the gross domestic product. So all the production that we do, goods, and then all the services that we also offer are all counted as part of our GDP. And these services are the recordings and the maintenance of data of the compilation of data of these particular services or the goods are done by the Ghana Statistical Service. So we have the Ghana Statistical Service. So we have the Ghana Statistical Service in charge of what? In charge of collecting. So the Ghana Statistical Service collects and records our GDP. That is one of their functions. So they keep track of all the production of goods and services that are being done. So now let's look at this. How do we measure GDP? How do we measure GDP? So let's look at measurement of GDP. Okay, we have three approaches. So here, to measure GDP, we have three approaches. Okay. We have three approaches. So the first approach we are looking at,
We have lost the screenshot.
I don't know why it's just maybe I clicked somewhere. Maybe I clicked somewhere. Okay, so let me just okay, I'm trying to bring it back. Okay.
Please, we can't hear you.
So we have the expenditure approach, we have the output approach, and we have the income approach. So these are three ways of doing what? Of measuring the market value of a country's GDP. Now let's look at the expenditure approach. So that is the approach that we are going to use. Let's look at the first approach, the expenditure approach. Now, the expenditure approach is the approach that we use based on the expenditure, okay, of the active, participants, okay, so or the various components. So in this particular case, we are looking at the expenditure of how many actors now. So here in the expenditure approach, we have three key actors. So the expenditure approach in terms of the actors or the agents, okay, we are looking at what? One, the households. We are looking at the households. We are also looking at what? Firms. We are looking at who? The government. And then finally, we are looking at the external sector. We are looking at the external sector. So for the expenditure approach, we are looking at the expenditure incurred by these guys. So we are looking at the expenditure incurred. Okay. And the expenditure incurred by these guys will all be summed up to get what is called the GDP. And then at the tail end of it, we can also have the external sector. Later, we will talk about this particular one. Now, when you look at the GDP, okay, using this particular approach. Now, for the households, what do households do? What do households do in terms of their expenditure? So this first one, we are looking at the households. So households do what? They consume. So households consume. So we buy some things to do what? To consume. So we have our what? Our consumption. So how the households, they do a lot of the consumption. We also have what? The firms. We have the firms. And the firms do what? The firms do the investment. The firms invest. They also spend some expenditure on what? On investment. So the household will spend on some expenditure on what? Consumption. Firms will spend some expenditure on what? On investment. Government would also spend some expenditure. Government will also spend some expenditure on what? On consumption. So government will also have consumption. Government will also have consumption. And then we talk about what? The external sector. We talk about the external sector. So government will incur what is called the government expenditure. Here we also have consumption and the rest. So with this particular approach, we are now going to look at what? The GDP as what? The summation of all the consumption of all the investments that are going on. So first, we're looking at what? The summation of what? The first one, which is what? The consumption plus investment of firms plus government what? Expenditure plus government expenditure. Government expenditure. Where C is the consumption. Is the consumption of what? Households. I is the what? The investment of which people? The investment of firms. Let me manage Jane somewhere. Jane is the government expenditure. Jane is the government what? Expenditure. So when you add consumption to investment to government consumption, you will get what is called the what? The GDP. You will get what is called the GDP. So if consumption is 5 and investment, if consumption is 5 and investment is 2, and then government expenditure is 10, our overall GDP would be consumption plus investment plus what? Government expenditure. So the overall GDP would be what? 5 plus 2 plus what? Plus 10. So the GDP would be what? This plus this, 7 plus this. So the overall GDP would be what? Would be 17. Would be 17. Now, you also realize that government or a country does not, please note, a country does not operate in autarky. A country does not operate alone. A country, note, a country does not operate, a country does not operate alone, but it engages in what? In international trade. So countries also engage in international trade. They also engage in international trade. And by engaging in international trade, it means what? By engaging in international trade, it means what? Countries export. By engaging in international trade, it means countries what? Export. And also do what? And also import. And also import. So for the export, we are looking at what? The goods and services, okay? The goods and services that we sell to other countries. That we sell to other countries to bring in income. To bring in income receipts. And by imports, we are looking at what? The goods and services we buy. Goods and services. Let me just do it this way. We are looking at goods and services countries buy from abroad. And payments made. So in this case, we have what is called the factor income, because here we are bringing in some income, and then here we are making some payments. So we have what? Our exports, and then we also have what? Our import. This is the external sector. This is the external sector. So here we are looking at the role of the external sector. The external sector. Because countries do not operate alone, they engage with the external sector. And by engaging with the external sector, we are talking about what? A country engaging in exports and then what? And import. Selling to people and then also buying from people beyond the four walls of what? Of the country. So which means that there's going to be an expenditure that is also going to be what? To be incurred. So we have to net out that particular expenditure side. Now, if a country, please note, and this I will ask you in the exams, if a country does not engage in international trade, which means the country is operating what? Alone. Now, if you want to add the external sector to the GDP, which means that by considering the external sector, our GDP would now be what? Consumption plus investment plus government expenditure plus exports, okay, minus what? Minus imports. Plus exports minus import. Export brings in what? Income. Export brings in income. So we are adding it here. And then imports, okay, we make what? Payments. So we deduct it out. So if you pick this two, exports minus what? Import, this measures the external sector. 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 Okay. So if a country does not import or export, please note, if a country does not import, if a country does not import or export, if a country does not import or export, what does that mean? It means that the country's export will be zero and import would also be what? Zero, which means that the overall GDP, okay, would be consumption. In this case, then our overall GDP would be consumption plus investment plus what? Plus government expenditure. Now, if a country does not export or import, it means that they are consuming whatever that is produced domestically. So if a country does not engage in international trade, please note, if a country does not engage in international trade, what does that mean? It means the country is in what? It means the country is in what is called autarky. It means the country is in autarky. The country is in autarky. And by being in autarky, it means that you are a closed economy. You are a closed economy. And by being a closed economy, it means that you don't open up to international trade. You don't buy anything. You don't buy anything from anyone, which is what import, and you don't also do what export, or you don't also sell to anyone. So you don't engage in international trade. And without engaging in international trade, we say the country is in what autarky, or the country is a closed what economy. So in this case, if a country is in autarky or a closed economy, then please note the overall GDP would be only consumption plus investment plus what government expenditure. There would be no external sector. There would be no external what? There will be no external. There will be no external sector. There will be no. So this is the GDP of a closed economy. So this is the GDP of a closed economy. And if the country engages in international trade, then we will have what? The GDP of an open economy. And by being an open economy, we will have exports, and then we will also have what? Imports. In other words, we will have the external sector as part of what? As part of the GDP. So this is closed economy. So this is the GDP of a closed economy. Now, if we also have government expenditure, consumption plus investment plus government expenditure, okay, plus export minus what? Import. This will be the GDP of what? Of an open economy. So this will be the GDP of what? Of an open economy. And it is open economy because of what? The external sector, because of the external sector. Now, if in a typical, case where government does not involve in, there's no government intervention. Please note, if there is no government intervention, if there is no government intervention, it means that GIN, which is government expenditure, would be zero. Please note, if there is no government intervention, which means government does not involve in expenditure, if government does not involve in expenditure, then it means that government component of the GDP would be what? Would be zero, which means that the GDP would now be what? Consumption plus what? Plus investment. That is for closed economy. Government plus what? Investment. Consumption plus what? Investment. So this is going to be the closed economy without government what? Closed economy without government intervention. And if there is still no government intervention, but they engage in international trade, then the GDP would be what? Consumption plus investment plus the external sector, export minus import. So this will be the GDP for what? For open economy. For open economy. So if I give you a question and then I give you all the values, GIN plus, okay, so let's say example. We have government consumption, and we have consumption of households to be what? To be maybe 2. We also have investment to be 1. We have government expenditure to be 3. We have export to be what? Maybe 5. We have import to be 2. And I ask you, please note, find GDP, assuming find GDP, assuming it is a closed economy, assuming this is a closed economy, assuming this is a closed economy, with what? With government intervention. Okay, with find okay, sure. A, with government intervention. B, without government intervention. Without government intervention. So how do we do it? The first part is talking about what? Finding the GDP in a way closed economy. So let's say the second one is find the GDP, assuming this is an open economy, assuming this is an open economy. A, with government intervention, and then B, without government intervention. So how do we solve this? So we are looking at what? GDP as C plus I plus what? G plus what? Export minus import. Now this is talking about what? Find the GDP, assuming this is a closed economy. So if it is a closed economy, it means that this whole thing, the external side would be what? Would be zero. Even though I've given you values for export and import, you don't use it because here I'm assuming the external sector is zero. So the 1A, for 1A, it means what? Our export is zero and our import is also assumed to be zero because it is a closed what? Economy. Because it is a closed economy. So then, what is the name? The A part is saying here with government what? Intervention. So if it with government intervention, it means that our gene is not equal to zero. So we have to use it. Okay, without government intervention, it means that gene is equal to zero. So in this case, our GDP would be this one here. Where is it? 2 plus 1 plus what? Plus 3. 2, our GDP would be this one. So here will be 2 plus 1 plus what? Plus 3. So the GDP would be what? Would be 6. The B part is without what? Government intervention. So without government intervention, it means gene is without government intervention, it means gene will be equal to 0. And without government intervention, it means that our GDP would be what? C plus what? Plus I. Remember, it is a closed economy. So the whole thing here about the external sector will be 0. So the GDP here would be what? Would be 2 plus 1, which will give us what? 3. Which will give us 3. The second part is talking about the GDP of an open economy, which means that we will now have to do what? So here is now the open economy. So for open economy, the GDP would be consumption plus investment plus government plus what? Export minus import. That is the external sector. So the A part is talking about what? With government intervention, which means that gene is not equal to 0. And without government intervention, gene is equal to 0. It means gene is equal to 0. That is for the second part. So here we are now going to have what? Our GDP to be consumption, which is what? Consumption is 2 plus investment plus government expenditure. This is an open economy. So plus export. So export is what? Export, where is export? 5 and import is 2. 5 minus 2. So here we will have what? This plus this, 3 plus this. We are going to have what? 6 plus this minus this, we have 3. This will give us what? 9. This will give us 9. This will give us 9 as the what? As the GDP. This will give us 9 as the GDP. So now the second part is talking about what? Without government intervention. It means that G is equal to what? 0. Without government intervention, G equal to what? 0. So G is equal to 0. So here it basically means that we will find the GDP, but without what? Government expenditure. So it will be this one plus, remember, an open economy. So X minus what? M. So here will be 2 plus 1 plus 5 minus what? 2. So here will be what? 3 plus 3. This will give us 6. So this will be the GDP without government what? Intervention. Without government intervention. Without government intervention. Now, notes for the external sector. For the external sector, we are talking about what? Export minus what? Import. So the export minus import is also called trade balance. It's also called trade balance. It's also called trade balance. If export is more than what? Import, it means that you do what? You sell more than you buy. If export is more than what? Import, it means you sell more than you buy. So which means that the export minus import, okay, would be greater than 0. It's going to be positive, will be greater than 0. In this particular case, we say you have what? A positive trade balance. We say you have what is called a positive trade balance. You have what is called a positive trade balance. Positive trade balance, which means that the country is importing more than it is exporting, which is good, which means that they are bringing more income than they are paying out to foreign countries. So we have positive what? Trade balance. Now, if export is less than import, it means that you are buying more than you are what? You are selling. You are buying more than you are selling. Remember, export is you are selling to people outside your country, and import means you are buying from people outside your what? Your country. So if export outweighs the import, it means that the trade balance, which is what? Export minus import, would be negative. Would be negative. And what does that mean? It means you have what? Negative trade balance. You have negative trade balance. You have negative trade balance. So when you look at the typical, import-driven country, so if export, okay, minus import is greater than 0, it means it is a what? We have positive what? Trade what? Trade balance. And what does that mean? It means the country is what? Export driven. Export driven or export intensive.
Yes, Doc.
Yes. Yeah, I can hear you.
Okay. So that means that Ghana in the position of what do you call it?
International trade.
Yes, on the international trade.
So it
because
means we are import driven.
Looking at we are in import trade balance.
We have what?
Ghana. I mean Ghana itself. We export more than we import.
Yes, exactly. So in that particular case, no, here export is greater than import. The first one, this one.
I know.
No, I'm just correcting myself here.
Okay.
So the second one is if. So that is where I'm now coming to. If export is less than what? Import. If export is less than import, It means that the export minus import will be less than 0. In this particular case, we say the country is what? Import dependent. The country is import intensive or import dependent. And here our key example is what? It's our dear country, Ghana.
Ghana, yes.
It's our dear
Thank you.
country, Ghana. So we always have a negative what? Trade balance. And by having a negative trade balance, it has implications on the economy, which means you buy more than you export. So you need to look for more dollars to pay for the exports because you can't pay with what? With CD. If you are doing international trades, there are certain things that you would be learning because you cannot buy with your foreign currency. You cannot borrow also money in your own foreign currency because of what is called the original sin hypothesis. Okay, so this the dynamic. So if I give you in an exam and I tell you to find whether the country is whether to comment on the external sector. So if I ask you to comment on the external sector, I'm basically asking you to do what? To tell me whether the country is export intensive or export dependent or import dependent by just looking at exports and then imports and knowing which one is greater than the other and knowing which one is greater than the other. Now, let's go deeper into consumption. Let's go deeper into consumption, the C component. Let's go deeper into consumption. This is my handwriting. Can you people see? Okay. So this consumption.
We
Now
cannot, sir.
you cannot.
Yes, please.
We're managing it.
That's good. That's good. That's good.
Hello, Doc.
You are managing it.
Hello, Doc.
Yes, I can hear you, Natural.
In fact, your tray.
Where is it?
The tray. If you can look at it for us,
the tray.
In fact, Doc.
Which tray?
Initially, when you're computing the GTP, the tray is they selected. I mean, tray. Just the number tray is not clear.
I didn't write it well.
In fact, so sometimes if you are doing your personal studies, it's always difficult to identify someone.
So this is it. This is it.
No, okay. Thank you. Thank you.
You're welcome. My handwriting is meanwhile I wrote my first copybook, my second copybook, my third copybook.
Maybe you have to repeat it.
It started in tech. It was tech that's for my handwriting. Okay, so let's look at the consumption aspect. Now we are consuming as an individual because we have income and the rest, and because we have income. Okay, now so you know that consumption C depends on our income. Consumption depends on what? Our income. And our income is what? Y. Okay, our income is Y. In this particular case, which means that consumption is a function of what? It's a function of Y. And with this particular Y includes taxes. This particular Y, that is the income, includes what? Taxes. This particular Y includes what? Taxes. This Y includes taxes. So it is not all the income that you earn actually belong to you because you need to remove the what? The taxes. Okay. So which means that the income that you will have after removing the taxes, that particular income is what you will use to do what? To consume. So which means that we can recalibrate this consumption function to be C. We can recalibrate this consumption function to be C is equal to, to be C, yes, is equal to a function of an income after what? After tax. So to be a function of income after tax. And the income after tax is called disposable income. Income after tax is called disposable income. It's called disposable income. So when you go and take your salary or your pay slip, how much you are paid is the disposable, is your disposable income when government taxes have been taken care of. And then that disposable income is written as YD. So anytime I write this, it means disposable income, which means that our consumption is a function of our what? Of our disposable income. And what is disposable income? Our disposable income is the income that we get minus what? Minus taxes. Where T is what? Taxes. Where T is taxes. Where T is taxes. Are we together? Are we together? Okay. So you would also realize that this consumption that we are looking at is a function of our disposable what? Income. And this is what we have here. This is what we have here. You should also know that the consumption that you will make depends on what? The marginal propensity to do what? To consume. Depends on the marginal propensity to consume. So now let's look at these components of what? Consumption. Components of consumption. Components of C. Now we have two components. The first one, we have what? The autonomous consumption. Autonomous consumption. And then the second one, we are talking about what? The induced consumption. The induced consumption. Now, for the first one, the autonomous consumption. For the first one, that is the autonomous consumption. Autonomous consumption. We are looking at what? Consumption that does not depend on income. Does not depend on income. Which means it is that part of consumption that you do what? You consume, but not dependent on your what? The amount that you have as an income. So it is autonomous. Whether you have money or not, you will still get that particular consumption. For instance, maybe at home, whether you have money or not, evening TZ, you will get evening TZ to eat. So that is an autonomous consumption. And then the induced consumption is looking at the income that part of income that depends on your what? On your income. Okay. So the induced consumption is that income that depends, please note, is that income that depends on your what? That depends on your income. So the consumption that we are talking about is, let's say, A plus. So which means this particular consumption that depends on your income. It means that you have what? Income. Yes.
Please, the induced consumption. Please, can you come over again? It's not.
Okay. So the induced consumption is that part of consumption that is the extra consumption that you get, the consumption that depends on your income. In other words, if you have higher income, you consume more. If you don't have higher income, you consume what? Less. So the induced consumption is that part of consumption. Okay. So it's that part of consumption that depends on your what? On your income. So the induced consumption, it's basically looking at what? The income that you have. Remember, we are looking at the what? The disposable income that you use to consume. Okay. This is capital C, and this will be small c. Where this particular small c is the induced what? Component. Where this whole thing is the induced what? Component. Okay. So if maybe let me just differentiate it between the capital C and small c. So I will use B. But here it is that income that you consume, whether you have income or not. So I can say that one is what? Is A for the autonomous. But for the induced, apart from the evening teaser that you will eat, you can go out and buy apple and eat. It is also a consumption. You are buying the apple to eat because you have what? You have more income. If someone doesn't have income, it means that person will not have the extra, luxury to go for an apple after having the autonomous consumption. Are we together? Which means that a typical consumption function comprises the what? The induced, the autonomous consumption plus the induced what? Consumption. Where this is the autonomous consumption, which is AC, and this whole thing is the what? Is the induced what? Is the induced consumption. Is the induced consumption. Are we together? So which means that our GDP, and you should also know that this disposable income is the amount of income after tax. So it also means that our overall consumption would be the A plus what? B. We open brackets, we will have what? Income minus what? Our T. Income minus our T. So this is the autonomous. So where, please note, where B is what is called the marginal propensity to consume. Marginal propensity to do what? To consume. Marginal propensity to consume. It is the extra income, is the extra consumption that you make when your income increases by 1 cedi. That's the marginal propensity to consume, which means that a complete GDP, which is what? GDP function, which is this one. If you break down the consumption component, you will now have the GDP as we have broken it down here. Our GDP will now be what? A plus B. Is that not it? Y is equal to plus investment plus this plus export minus what? Minus import. Where this represents what? The consumption. So if I give you values for taxes and the rest, you should be able to find the what? The GDP. So for instance, if consumption is equal to 2, and then let me just also mention this. This marginal propensity to consume is less than 1. It's less than 1. So we have the marginal propensity to save and marginal propensity to consume. And the summation of the two, marginal propensity to save and marginal propensity to consume, should be equal to 1. There should be equal to 1. I wouldn't want to go there. Okay. So if C is equal to 2, maybe 20 plus 0.1. 0.1 YG. This one is equal to 50. Government expenditure is 70. And then we are saying tax is equal to maybe 2. Export is equal to.
Look.
Let me mute him. Okay, so export is maybe say 100, import is 80. Are we together? And I asked you to find, so here I will ask you to find equilibrium national income. Please note. Equilibrium national income. Equilibrium national income. Equilibrium national income. So you should know that here we will let So here, if I ask to find the equilibrium national income, given this particular case, okay, you will know that our GDP solution, our GDP would be this plus what? This plus export minus what? Import, plus export minus import. Okay. At equilibrium national income, please note, at equilibrium national income, at equilibrium national income, at equilibrium national income, GDP should be equal to Y. GDP is equal to what? Y. So this our GDP will be equal to Y. So we have to break them down, especially the consumption function, because we have what? Value for investment, we have value for government expenditure, and the rest. Okay. So our consumption, remember consumption function is what? Where is it? 20 plus 0.1 YD. Is that not it? So we have to break this down. And we know that YD is equal to your what? Your income minus what? Taxes. And then the YD is income minus taxes. We don't know the total income, but we know the taxes. The T is given as what? The T is given as 2. So minus what? Minus 2. Minus 2. So our consumption would be 20 plus 0.1. Y minus what? Minus 2. Y minus 2. Y minus 2. So here would be 20 plus 0. Y minus this times this. What is the name? 0.2. 0.1 times 2. So 0.1 times 2. Let me just 0.1 times 2. 0.2. 0.2. So this will be our consumption function. This will be our consumption function. And remember, our GDP is this one. So we will now have what? GDP is equal to 20 plus 0. What? Y. Is that not it? Minus 0.2 plus, so this is the consumption. So plus investment. Investment is what? 50. Investment is 50 plus government expenditure, which is given as what? As 70 plus export minus what? Import, which is here. Export is 100. Import is what? Is 80. So export, okay, here, let me change it. Let me change it, please. I want to, so here will be import and here will be export. So here would be what? 80 as export minus 100 as import. So 80 minus 100. Okay. So what will you get? So we are going to have 20 plus what? 50 plus 70. 20 plus 50 plus 70. Here will be negative. Is that not it? So minus what? 20. Minus 20. So this will be 120. So your GDP would be equal to 0. Y. This whole thing is plus 120. Plus 120. Plus 120. But you will know that at equilibrium, like we said, at equilibrium, Y is equal to what? GDP. So which means that this will be equal to 0. What? Y plus 120. So here would be what? When we group like terms, Y minus this one is equal to 120. So this minus this will be 0. What? 9Y. Here is the same thing as, let me break this down for you to see. So we let Y.
Prof. Hello, Prof.
Yes, I'm listening.
Yeah, please, can you go back where we started with the 0. Y plus the 2 small, this place. 0.y minus 0.2. How we came out? How you do the summation? I
No,
didn't
yeah,
get
it's
that
true,
part.
it's true. I even myself, I've skipped something. Okay, so here, remember here we are looking at what? This 0.1, this 0.1 times y, which is this one, and then this 0.1 times 2, which is this one. So this whole thing is the consumption, which is here. So we are now going to do what? To add. So it is going to be this 120 minus what? 0.2 plus 50 plus 70. Remember here is what? Minus 20. Is that not it? Here would be minus 20. So this is definitely, you know, this is a negative trade balance. This is a negative trade balance. So here we are going to have 20 minus what? 0.2. I skipped. Thank you very much.
Yeah.
Plus 70 plus 50 plus 70.
Okay.
Are you getting it? Here
Yes,
is going to be minus 20. Minus what? 20.
Yeah.
Minus 20. So we are going to have GDP. We are going to have GDP is equal to 0. What? Y plus 119.8. Thank you very much. Thank you. Thank you. So I was leading you people into abyss until a savior helped us. So 119.8.
8, yeah.
So if we group like terms, here will be what? 1. Is that not it?
Yes, sir.
Here would be 1. Minus here would be what? 0.1. It's equal to 119.8. So here will be 119.8. So what will we get? We are going to have 0. What? 1 minus 0.1. We are going to have 0.9.
Yeah.
Y is equal to 119.8. We divide here by 0.9, divide here by 0.9.
Yeah.
This will cancel this. So our national income would be what? 119.8 divided by 0.9.
Hello, doctor.
Yes.
Yes, doctor. This particular place, the one that you have, when you group like them together, where you have y open bracket 1 minus 0.1. That is why I don't understand. Because
Okay.
yes, I do understand the y is standing, so the 0.y is crossing the equal sign, so it's been negative there, which is equal to 119.8. How come by your next step that you have y open bracket 1 minus 0.1 into bracket? How come you arrived at that figure? Please kindly explain to me.
Okay, so from this stage, we group like terms.
Yes.
Or we factor out. You group like terms or you factor out. You group like terms or you factor out. So here, I'll just try to simplify here. You know, any number standing alone means there's 1 attached to it. But here we have y here. We also have y here. So y is the common factor out here.
Okay.
So we have that particular y here. This one. And when you open brackets, it will now be left with what? 1.
So it will be the same, don't you?
It will be the same. It will be the same.
Yeah.
So minus. So here is 0.y. So which means there is also 1 if you factor this y out. So it's going to be the same 0.1.
Okay, thank you very much. Let's advance.
Okay, thank you. So this is going to be our national or overall national income, our overall equilibrium national income. So this is the overall equilibrium national income or GDP. So if I ask you to comment on the what? On the trade balance. If I ask you to comment on the trade balance. If I ask you to comment on the trade balance, what does that mean? So to comment on the trade balance. What does that mean? The trade balance would be what? Export minus what?
Minus
Import. So we
import, yeah.
have what? 80 minus
80
what?
minus
100, which is what? Negative
negative
20.
20.
Or you can just put it in brackets. And what does that mean? It means the country
It's
import
import intensive.
is import intensive. They import more than the what? The export, which means the country is what? Import dependent or import intensive. Import dependent or import what? Intensive. Import dependent or import intensive. So if I tell you to if the external side is 0, it means export minus import is 0. What is the country practicing? They are practicing what? Autarky. Remember, the closed what? Economy. So with all this, if I ask you to estimate the equilibrium, here I can say find the equilibrium national income, assuming the country is closed, which means assuming a closed economy. So which means you don't have to do what? To bring this part, export minus import, which means that the negative 0.2 here, 20 here will not be there. So you are basically just deducting negative, you are deducting 20 from this ones. Are we together? Okay. Any question? Any question? And sometimes if the tax, we can give the tax as a tax rate. And this will also further complicate the analysis. So instead of just saying the tax is 20 as we have here, I can give you the tax rate to maybe maybe the tax rate is 2%, 0.02, and you then apply it on, on income and whatever to know the overall tax which is deducted from the income to get the disposable income to get the disposable income. Okay, so this is how we do it, and you would have to. So let me see whether I have this past question that this thing came. Let me see. I don't know whether it's here. Excellent. So last year there was a question on this. So look at this question, the B part. For a closed economy, which means that immediately you hear a closed economy, there is no export, there is no import, with no government intervention. For a closed economy with no government intervention. So clearly, there is no export, there is no import, and there is no gene, that is the government expenditure. The consumption function is given by C is equal to 0.6y plus what? Plus 10. And planned investment, that is the I, is what? Is 12. Calculate the equivalent level of what? National income. And you know the equivalent level of national income. That is what we just saw. So here is just straight away. We didn't bring disposable income. Okay. So, but in your question, I'm going to bring disposable income. So we didn't bring disposable income. So it was just straightforward. So it was just 0.6y plus 10 plus 12 is equal to y. Then you make y the subject and divide. That was just what we basically needed to do. And then the consumption function. So now that you find y, what will be the consumption? So you plug in y in the consumption function to get the whole consumption. Then savings will be what? Your income minus what? Consumption. So let me do this. So based on this, what will be the consumption? The consumption. So if I ask you to find the consumption, remember the consumption function is what? Where is it? This is the consumption function. This is the final consumption function. So if I ask you to find the consumption function, where is it? Yeah. So we now know what the y. Even from here, we can get it. We now know y. So the entire consumption function will be 20 plus 0. What? 1 yd, and we know y, and we know tax. Is that not it? Remember, let me just do it. Finding the consumption. So consumption is 20 plus 0.2 YD. Is it 0.2 YD? 0.1 YD. 0.1 YD. 0.1 YD. So we have consumption will be what? 20 plus 0.1 Y minus what? T. And we now know the values for all. This one will be 20 plus 0.1. Y is what? Remember we found Y. 1, 1, 3, 3, 1, 3, 3 points. 1, 1. 1, 3, 3.11 minus T. And we know T. T is what? Where is T in the question? T is 2. That is tax. So tax is 2. So minus 2. So consumption will be what? Here would be 1. The 133.11 minus what? Minus 2. So here would be 20 plus 0.1. 131.11. This one times 0.1. So here will be 20 plus 13.123. So here would give us 33.111. So this is our consumption. This is our consumption. And if you are asked to find savings, so savings will now be what? Our consumption minus what? Savings will be your what? Our income. If I ask you to find the national savings, so the national savings would be consumption, the income, that is the national income, minus what? Minus consumption. And how much did we find as the national income? We found that we found it to be 1.3, which is here, the Y.
Yeah. 133.11.
133.11 minus consumption, minus how much we consume. 33.11. Okay, so this, let's say national savings will be what? Will be 100. Will be 100. Are we together? So this is how you do it. So the key focus is for you to get the consumption function right. If the consumption function is right, your national income will be wrong. Your equivalent national income will be wrong. The consumption, the value of the consumption itself will be wrong. The savings will be wrong. So you will lose a lot of marks. You will lose a lot of marks. Any question? Any question? Any question? Okay, so that ends this particular side. So now let's look at the next side. The next side. So here, let's look at the government budget, and this is part of the assignment. I think question that big table, was it in question 2? Government budget. Government budget and credibility. Government budget and credibility. Okay. Now here I'll share the slides with you on this one. So let me see whether you can let me stop sharing this one and then let me share. Okay, so let me stop sharing here and then I will share. Do I have it here? Okay. Where is this one? Okay.
Prof, Doc,
Yes.
I want to ask you a question, which is not part of this. I don't know what I can ask. In economics, the wage rate, does it affect the demand or supply?
In what? Are you referring to the
In
question? What is the name? The assignment?
No, it's just a question.
Which question are you asking?
I want to know in economics, like the wage rate, does it affect the demand or the supply?
No, wage rate, I thought we mentioned it. It's the price that you use to supply. It's the price of what? Supplying the goods and services.
Okay.
So if the wage rate is high, won't you go into the market to do what? To offer your services?
Okay.
So the higher the price, the more. Can you see my screen?
No, please.
You should see it.
Can't see the screen now. We can
Yes,
see
we
it.
can see.
So we can see the screen now.
Okay, so I'm moving to the next
can't see.
topic.
Hold on.
You can't see.
We can see.
Okay. So, but you can still hear. Can you hear me?
Yeah, we can hear you. Yes, we can hear
Excellent.
you.
Good. So now let's look at this particular one. So here we are looking at judging the government's fiscal credibility. Now, when you look at the typical government budget, okay, we are basically looking at the forecast. Okay, so by the forecast, we are looking at what the government is planning to spend and what the government is planning to receive in revenue. Okay, so with the government budget, is typically a forecast or a projection of government expenditure and government's revenue. So anytime they are presenting the budget, government will talk about how much government wants to spend and in which sectors, and how much it plans to receive as government revenue and from which sector, whether through taxes or through non tax based income. Now, if you pick a typical government budget, government will have what is called the overall balance. And this overall balance is looking at how much you receive versus how much you spend. Okay, how much you receive versus how much you spend. So the overall balance is going to be positive, okay, if the government revenue is more than the expenditure, which means that you receive more than you spend. So your overall balance, which is OB, would be what? Would be positive. And this OB is called a fiscal surplus. So it's fiscal surplus because you have a lot of revenue, you spend and then leave the rest. So you have positive fiscal balance, or you have positive overall balance. However, if you spend more than you earn, which means you have less revenue and then your expenditure is more, you have what is called the negative overall balance or fiscal deficit. In Ghana, we always have or negative, for the most part, we have negative overall balance. In other words, we are always running into deficit. And this overall balance is also called the net lending. And now, if you pick the typical government budgets, okay, how do you read it? The finance minister will prepare a budget and come and read. It's not the statement that the government that we are asking you to read. It is the entire budget with the estimates. When you pick a budget, okay, a budget has two components. So for one, we have what is called the above the line items. And we also have what is called the below the line items. Please note. So a typical budget statement would have the above the line items and we have the below the line items. Now, the above the line items, we are looking at the items that define whether government is going to make revenue surplus or government is going to run into deficit. And what makes government run into deficit is because expenditure is more than revenue. What makes the government runs into surplus? Because revenue is more than expenditure. So which means that the above the line items is typically looking at the revenues, the various revenue sources and the expenditure sources. So a typical budget will have the above the line items, and the above the line items are those items, okay, that leads to either the government overspending the budget or spending under the budget. In other words, government running into deficit or government running into surplus. So the above the line items are the revenue items and then the expenditure items. Now, if expenditure is more than revenue, if expenditure is more than revenue, it means what? It means government is embarking on fiscal deficit. is embarking on fiscal deficit. And by embarking on fiscal deficit, it means that revenue is less than the what? Expenditure. So you have to know how you are going to finance the negative balance. And the below the line items will now tell you how the government is going to finance the negative balance. So if you spend, you have your spending items, you have your revenue items, and if the revenue is less than the what? The expenditure, it means that you need to tell the country how you are going to finance the what? The negative balance. In other words, how you are going to finance the what? The fiscal what? Deficit. And then the below the line items will then be a list of how the government is going to finance the what? The fiscal deficit. So whilst the above the line items talks about the revenue expenditure items, the below the line the below the line items shows the what? The financing items. Now, one key way that the government can finance the the fiscal deficit is through borrowing. Is through borrowing. And government can borrow domestically or government can borrow externally. Okay. And from domestic resources, government can borrow from central bank. So here you will find Bank of Ghana borrowing to lending to the government. Okay. And I know previously, so when the government is taking money from central government, from central banks, we say the central bank is financing government deficit. Before 2015, the government central bank was financing Ghana's budget. In other words, the budget will be in deficit, and central bank will finance some of the fiscal deficit. Previous governments, like the NDC government, whatever, they didn't actually enjoy much of the central bank financing government deficit. But IMF, with the IMF program, we had that was the GM's time. We had the a conditionality, which was a zero central bank financing, which means that whatever deficit that we incur as a country, the central bank should not finance you. So they gradually reduced the percent. First, it was capped as 5%. Central bank can only finance maybe 5% of government revenue, and then gradually they reduce it to zero central bank financing. So like the previous, like for instance, GM didn't enjoy the central bank financing because of the IMF conditionality. But the current government is enjoying central bank financing. So they run into they have fiscal leadership.
Hello? Hello?
Yeah, so whether legal or illegal, you will find the central bank actually giving the government some money to finance its deficit. And I know recently the minority side in parliament were saying this, what is the name? They found about 200 million Ghana cedis being given to government to finance their budget, which is illegal or whatever. The legality of it is something that we cannot talk about, but yes, central bank, the current government enjoys central bank financing. Government can also issue bonds to borrowing from individuals or institutions as part of mobilizing revenue or resources to finance, the fiscal deficit. And with this one, it means government is giving you domestic paper, okay, to residents to be able to borrow to finance key expenditures. Another key source of domestic revenue used to finance fiscal deficit is through the seigniorage. It's through the seigniorage. It's through what is called the seigniorage, and the seigniorage is basically the profit that you make from printing money by the central bank. So yes, of course, the current government prints a lot of money, and it's not that they are printing a lot of money to give to individuals. They print because they want to get the seigniorage, which is monies or the profit from printing money. So, for instance, if you spend maybe say 5 Ghana cedis to print, okay, let's say if you spend 7 Ghana cedis to print the 10 Ghana cedi note, to print 1 10 Ghana cedi note. It means that the seigniorage or the profit will be the value of that particular money, which is 10 cedis, minus how much is spent in producing that particular note, which is 7 cedis. So the seigniorage is going to be what? The 10 cedis minus what? 7 cedis, which is 3 cedis. So you then imagine how many 10 cedis have they produced as a country. So you multiply. We have 200 Ghana cedis note. So let's say government spends maybe 20 cedis to produce just one 200 Ghana cedis note. So the seigniorage will be how much the money is valued, which is what 200 cedis minus how much is spent in producing the 200 cedis, which is what 20 cedis. So the seigniorage is the what? Is the 180, which is the 200 cedis minus what? The 20 cedis that they use to produce it, which means that for each 200 Ghana cedis, government is making 180 Ghana cedis. So assuming they print 40 billion, you can imagine how much they are going to make. So the current government also prints a lot of money, and they are printing it because once they are done, central bank will push the seigniorage to the government to spend, and government will use it to support the budget. So the seigniorage, so imagine they spend money to produce 2,200,000,000 Ghana cedis, and then how many notes? 100 Ghana cedis, how many notes have they printed? 50 cedis, how many notes have they printed? 20 cedis, how many notes? And then 10 cedis, how many notes? So you can imagine the seigniorage on each of these notes multiplied by the overall value, and then you can quantify the amount of seigniorage that the government gets from printing money. So it is one lazy way of raising money. You just print money, get the seigniorage, and then spend. Now, beyond this, government can also engage in foreign borrowing. Yes.
Doc.
Yes.
Hello, Doc.
Yes, please go ahead.
Doc.
Yeah, I can hear you. Please go ahead.
I want to find out something. Based on the scenario.
Yes. I can hear you. Please go ahead.
Please stop. You can hear.
Sir, continue. Yeah.
Okay, good. Okay, so government can also borrow externally. So which means that if government explores domestic revenue, domestic sources, and the revenue is not up to what they were expecting, they can go and borrow externally. And one key way that they do it, they can borrow from foreign banks. So in this case, it will be bilateral, creditors. Okay.
No.
And largely these bilateral creditors are commercial creditors. So government can borrow directly from banks to come to the country to spend to support the budget. Government can also issue bonds. Yes, please go ahead.
Please, why will it be considered borrowing if government of Ghana should take money from central bank, since central bank belongs to government?
No, it's borrowing because the two operate independently. So once you are borrowing, you have to pay back. Yeah.
Okay.
Okay.
Thank you.
So government can also issue foreign bonds, and those foreign bonds are issued at the international capital markets. And those bonds, they can be issued in pounds. You can issue the bonds in dollars. You can issue it in euros, and you can also issue it in yuans. But in the case of developing countries, especially like those in Africa, we can't issue or we can't borrow in our own currency. And this is what I say the H.N. Greens mentioned as the original sin, where countries cannot borrow in their own currency. So you always borrow in foreign currency, exposing you to exchange rates volatility. Okay. So you issue
hello, sir.
bond. Yes, please go ahead.
Yeah, I wanted the seigniorage.
Yes.
How do you determine the amount that the government borrowed? Now he borrowed, let's say, the print, let's say, 2020, 200 notes.
Let me just correct this. For the seigniorage, government is not borrowing. Even though I've here domestic borrowings, yes, credit from banks, you can also issue, but seigniorage is not borrowing. So go ahead.
Okay, then that's what I wanted to find out, if it's borrowing or how to determine how much is borrowed. But if it's not borrowing, then that means that there's nothing like to find out what I was trying to ask.
Okay, thank you. It's a domestic source, but it's not borrowing. They just print, then say, oh, this is your share. then the central bank, Addison will give to Nana, and they go and support the budget. Okay, so now let's look at the euro bonds. So the euro bonds, we go to the international capital markets to borrow, and then we service our debt. And this is also one key way of raising domestic, in fact, huge external resources to support the budget. Ghana, with our first time we went to the capital markets to exploit this option was in 2007. And we borrowed a lot, and now we've had several instances where we've always been borrowing from the international capital market. If we were doing debt management, I would have gone deeper into these particular issues. This is actually something that I like doing. So, for instance, in March 2020, we borrowed a lot of money from the international capital markets. And when you do a lot of analysis, you will find that the current government actually utilize a lot, of these options, especially issuing the euro bond to support the budget. From the first time we went to the capital market in 2007 till the time NDC left power. So for all the previous government, I think we borrowed about 3.15 billion US dollars from the international capital market. But from the time at least the current government took over in January 2027 to now, we've borrowed 15 billion. We've borrowed 15 billion to support the budget, which is like 5 times more than all the previous government. So it's a way of raising revenue. Yes, please go ahead.
Yeah, so Doc, borrowing from externally, if Ghana wants to borrow from Togo, it means we are going to borrow with the hard currency, or we can borrow Togo currency.
No. It depends on whatever what is the name currency that the contract allows you. So that is why I was mentioning the various currencies. We borrow in dollars, in pounds, in euros, in yuan. Okay, and some can, like for instance, I know this developing was it Tajikistan or Kazakhstan? They borrowed in their own currency. But for us, you cannot come to US and say I want to float bonds, but the bonds I'm going to use borrow in local currencies. No. So mostly those are the 3 key currencies that we borrow within the
for instance, Ghana government need money, maybe Nigeria government to support its budget. Or going in for Nigeria to help Ghana, it means we are compelled to borrow from Nigeria in dollar or euro.
No. You are not compelled to borrow in any currency. Like I mentioned, it depends on what you agree to. So, for instance, I know this country, Uganda. Okay. Uganda has some loans with Iraq.
Okay.
But it's in dollars, but they don't spend dollars.
Okay.
Yes, they don't spend dollars. So, for instance, you can also borrow someone dollars, but you don't spend. It's not illegal. Something that is illegal. I don't want to say illegal tender. It's something that is not really commonly used in Ghana to buy or sell something.
Okay.
Doc.
Yes, I'm here.
Why will government continue to borrow to finance its budget, since government can spend with its revenue?
No, government cannot spend within its means, so they always borrow. Unfortunately, we spend a lot than we get in return. And for that matter, borrowing tends to be one of the laziest way, especially from the international capital market, until the market shuts down on you, that no one wants to borrow you 1 cedi. So for now, you can even notice government cannot borrow even 1 cedi from the international capital market because we borrowed excessively and irresponsibly when you do the analysis. Like I mentioned previously, we were accessing international capital markets. 2007, was it Bawuri or whoever was the finance minister, they accessed it. So when we picked from the first time we got to international capital market to borrow, to the time NDC left, cumulatively we borrowed $3.5 billion. But from the first time the current government took over, they found it was a way of raising revenue. So they borrowed. So from the time they took over, 2017 to now, they borrowed 15 billion, which is, like you mentioned, which is exceedingly higher than all the borrowings from the previous government. In fact, on the 21st March 2020, they borrowed 3 times from the international capital markets, and cumulatively, they borrowed 3.11 billion one day, which was almost the same money that previous government borrowed combined. We can do further analysis on some of these things, and they come at a cost.
So Doc,
Yes.
so Doctor, do we have a case in the world economy where a country spend very lesser than their revenue? Do you have a scenario like that?
Oh yes. That is if a country has fiscal surplus. Yes, we have. Even Ghana at some point, I can't remember, but when you look at the trajectory of our fiscal, deficit surplus, there was a time we had a fiscal surplus. There was a time we had fiscal surplus. In other words, there was. Yes, I can't remember. Yes, but obviously not Rollins, obviously not Kufuor, obviously not Atta Mills, definitely obviously not GM, and definitely obviously not under Nanado. Yes. Okay. Now let's make progress. We have a lot still. Now, having said that, how do we assess the credibility of the government budget? In other words, government can make the budget actually look very good because it is a powerful tool, fiscal tool of what is the name of government policy direction. Okay, so sometimes government can give you the impression that the budget is very good. Meanwhile, deep down, it's not. Government can slant the budget to make it look more favorable for people, because investors look at the budget to see if there is hope in it. You and I also look at the budget to see if there is anything in it for us. Credit unions, what is the name? Labor unions, they all look at the budget and make noise. Yeah. Then you need to know if the government is actually, massaging some of the figures in the budget to make it look quite credible. Okay, so you need to be able to analyze the budgets, okay, to determine credibility. To determine what is credibility, because like we mentioned, government budget is a powerful message that the government use to project its fiscal policy. And by fiscal policy, we are looking at government expenditure, and we are looking at government revenue. Government expenditure, and we are looking at government revenue. So how do we assess the credibility of a government budget? And this is one of the the questions that I gave you in the assignment, and it is also a question that will be coming in the exams. So how do we assess the credibility of a government budget? So now let's look at these two things. One, we have the revenue side. So to assess the credibility of a budget, if I give you the budget, you look at the revenue side. And the revenue side, like I mentioned, we have two types. We have the tax-based revenue and non-tax-based revenue. But the tax-based revenue in the budget forms the majority share in government's total revenue. So for the tax revenue, we are looking at what the amount government earns from taxes, both direct tax and indirect tax. And in the current budget, we have about 81% of our budget revenue coming from taxes. When you look at we did an analysis of the budget, and we found that I will share that particular paper or analysis with you. It was even published in Business Times. Okay, so our findings showed that 81% of government revenue, okay, revenues are going to be gleaned from taxes. So because it forms the largest share of government tax revenue, we normally pay much attention to it as a way of doing further analysis in terms of the credibility. The other non-tax revenues, like the grants, for instance, they are idiosyncratic. So you only look at the grants that are actually committed and not grants that are anticipated. So we focus only on the tax-based revenue. So to look at the tax-based revenue, what do you do? One, we look at what is called we use two measures to assess the tax component of the revenue side. So we have two ways of actually looking at it. We are looking at it in terms of its responsiveness to the overall tax base. So one, we look at what is called the tax elasticities. So to assess whether government revenue projections are actually credible or not, because government can tell, oh, we are going to raise a lot of revenue, and with this revenue, we will use it to build roads, we will use it to construct, we will use to do this, and then we are happy, saying, okay, fine, government is going to take more revenue to develop the country, and you clap, more revenue will be coming. But government may just be saying this to please you. In reality or in practice, it's going to definitely be different. Government will always struggle to raise the revenue and tell you to bite the bullet or to tighten our belts. But in the budget, they said they were going to raise a lot of revenue for developmental projects. So we shouldn't worry, we will see a lot of development. They just read this in Parliament, and then when you look at the budget, it's also good. But in reality, they will tell you, oh, the fiscal space was actually constrained, so we weren't able to raise much revenue. The problem is not that, it's how much you have actually estimated in your revenue side of the budget. That is where the problem is. So you need to make sure your revenue side projections are actually true and credible. We use two ways. One, we estimate what is called the tax elasticities, and two, we use what is called the tax buoyancies to be able to do that. For the tax elasticities, we are looking at what? The changes in the tax, okay, are resulting from the changes in the tax base when you don't increase the tax rates. In other words, government can increase the tax rate to increase revenue, or government may not increase the tax rate and it will increase revenue. Why? Because it is going to broaden the tax base. The tax rates may remain the same, but government can broaden the tax rates. So the changes in your revenue as a result of the changes in the tax base, if the current taxes are held constant, okay, will be measured by what is called the tax elasticity. So we will do this. Now, the second one that we also use, which is actually very good, is the use of our tax buoyancies. Because with the tax buoyancies, we are looking at your changes, the changes in your revenue as a result of the changes in the size of the economy. So as the economy continues to grow, you get more taxes, because the amount of production of goods and services that are done, okay, in a country would also influence how much revenue government gets. So even if you don't increase your tax rate and the GDP grows, it means that people have been able to produce, firms have produced, which means that with even the constant tax rate, your overall revenue is going to increase, because constant taxes applied on what? On an increasing value of what? Production. So if Baumia, for instance, was saying we are going to move away from taxation to production, it basically meant that we can keep the tax rate constant or even reduce the taxes, but increase the value of the GDP. Because once you increase the value of the GDP, it means that the market value of goods and services will be higher, and then you raise more revenue. So it's just like saying, okay, fine, I'm not going to increase your taxes, but work harder. Because once you work harder, you increase production, and then government can get more taxes from it, rather than leaving you to be working as business as usual and then increasing the tax rate. So moving from taxation to production basically means keeping either the tax rates unchanged or reducing it, and working towards building the size of the economy through the nominal GDP. But now we see that we are basically, moving from, production to taxation, as opposed to what was said earlier. So those two things, when they come to play, will give you whether what the government is saying is actually credible or not. So the tax buoyancy, we are looking at what? The overall tax revenue, the percentage change in the tax revenue, divided by the percentage change in the nominal GDP. The value that you will get will let you know whether what the government is projecting in the budget is actually credible or not credible. In all these things, we estimate it and then compare to historical trend. For instance, if we look at the budget, the tax buoyancy, and the tax buoyancy for the past 3 years, for instance, has always been between 2 to 4, example, between 2 to 4, because you will get figures. So if maybe the tax rate, the tax buoyancy for the past 3 years has always been value between 2 to 4. But in the current budget that the government is reading to the parliament, you find the tax buoyancy to be 7. this is significantly higher than historical trend. It may not be true. So if tax buoyancies are intrinsically and outrageously higher than the previous trend, then it gives an indication that the budget is not credible, especially the revenue projections are not what credible. So when you even see the question that I gave you two historical tax buoyancies, and then I will expect you to calculate the current tax buoyancy. If it is significantly higher than the previous tax buoyancy, it means that government budget projection might not be credible because you have to ask key questions. How are you raising the taxes to finance, to be able to have higher tax buoyancies? And we were talking about that later. So an excessively higher, elasticity or tax buoyancy relative to the historical trend, it raises some doubts about the credibility of government projections. So in this case, what are the key questions that you should be asking? So if, like I mentioned, if the previous historical tax rates, tax buoyancy, for instance, ranges between 0.3 to 1.9, and you have a lot of, you have the current tax buoyancy to be, say, 5. The last tax buoyancy was for the last budget was 1.9. But in the current tax buoyancy that you have estimated, you have 5 as the tax buoyancy, which is significantly even higher than the last previous tax buoyancy of 1.9. Then the government need to answer a lot of questions. And what are the questions? You need to ask government whether there is going to be some additional taxes that government is going to be introducing. Will you be introducing additional taxes, or you would be what? You would be increasing the tax rates. So we have two things. One, you increase the additional taxes, or you do what? You broaden the tax brackets. So one key question is, given the higher tax buoyancy, what will you be doing to do what? To bring in more revenue. That will be excessively higher than the previous trend. So key question, will you be introducing new taxes, or will you be increasing the current tax rates? Another key question that you should be asking government, because the tax buoyancy is very high, has to do with what? The revenue mobilization administration. Would you be using digitization to plug in the revenue loopholes? Or will you be reducing corruption in the revenue collection processes? Are we together? So in this particular case, what will you be doing that will be unusually be bringing in more revenue than the norm? So one key thing is, what is the government going to do to bring in revenue from these taxes? Will you also be increasing the tax rates from the high income earners, or you will be increasing the tax rates from the low income earners who are normally higher at the bottom of the horizon? In Ghana recently, we increased the tax rates before the previous finance minister left. They increased the tax rates for high income earners. It is a way of increasing the tax revenue. You may leave the low income earners unchanged, but in terms of the tax rate, you may increase for the high income earners. Or what will we be doing to influence our tax morale? And the tax morale, we are looking at the probability of us, defaulting or dodging or avoiding tax if we get the opportunity. For instance, cost rep, if no one is watching you, will you evade tax if you get the opportunity? Myself, I will avoid paying tax if I get the opportunity. So the possibility of avoiding or cheating on tax if you get the opportunity is called a tax morale. So what will the government be doing about our tax morale? And the tax morale also depends on a lot of factors, including the credibility of the budget, fiscal components, and maybe people's religiosity. You may be too religious to cheat the government, or you may be too educated to cheat government because you know the importance of tax revenue. So these are some of the things that you will be talking about in terms of the key questions that you should be asking the government from the revenue perspective. Okay, haven't computed the tax buoyancy to know that it is exceedingly higher than the previous trend. Now, from the expenditure side, what will we be looking at? So from the expenditure side, you can divide the expenditure into two. One, we are looking at the non-discretionary expenditure, and then two, we are looking at the discretionary expenditure. So for a typical budget, remember, We are still looking at what the above the line items. So on the non-discretionary expenditure items, we are looking at those expenditures that government cannot change without amending a contract or law. They are non-discretionary. Whether you like it or not, those are the expenditures that we need to incur. For instance, governments would have debt to pay. Those debt services, the interest payments on those government debts, these are non-discretionary expenditure. You can't say I'm not going to pay to service my debt. No. Government social security, no matter how long it takes government to pay social security in Ghana, government would definitely have to pay those social security because it is also a non-discretionary expenditure. In some countries where they have unemployment benefits, they pay for government pays those unemployment benefits. These are non-discretionary expenditure. The second part is the discretionary expenditure, and for them, those are items that the government can alter or can change without considering the law in most of the instances. So, for instance, government can say, okay, this year I'm not going to invest in infrastructure, which means that our gross fixed capital formation is going to be lower. Okay, and the government can just do that without having to go to parliament to amend those laws, because I can tell you I don't have much revenue this year, so I'm not going to spend a lot on infrastructure. Another key non-discretionary expenditure is the wage rates. Okay, those are discretionary expenditure. The government compensation. Okay, those are discretionary expenditure that government can also use. So how do you do this? To be able to assess the credibility of the budget from the expenditure side, you look at the non-discretionary components and then you look at the discretionary component. So, for instance, if you look at the wages and salaries, for instance, if government's current budget for wages and salaries, okay, is lower than the previous year. So you just look at the current year budget, how much government is proposing as wages and salaries, which is always available in the budget, and look at how much it spends in the previous budget. If it is lower, then you ask government that question, whether government is actually going to retrench people. Because if not, why would your wage bill be lower? Do you also plan to reduce our salaries? Otherwise, why will the wage bill be lower? So you ask government questions about whether there's going to be some possible retrenchment. And in that case, you also know the consequences, political upheavals, arrests, protests, and the country will be ungovernable, because if you want to retrench people to reduce your wage bill, it has some political, repercussions, okay, and social repercussions as well. So you can also ask government about this layoffs of employees, or you are going to reduce people's salaries. For instance, if government is also spending lower on maybe say social intervention projects, you ask government why, because you are comparing to previous one to see if that is also feasible. If government is going to reduce expenditure on infrastructure, you ask the government why. Is it going to be one-off, or it is just going to be something that will be sustained over a period of time? And what will be the consequences to our infrastructure stock if you are not going to spend on infrastructure? At the macro level, we proxy infrastructure by the fixed government, gross fixed capital formation. And the data on this is always freely available. So we can do an analysis of government expenditure, maybe say previous government and current government, using the gross fixed capital formation to know which particular governments actually did more in terms of adding to our national infrastructure, our stock. So you ask government about whether there's going to be possible retrenchment, whether there's going to be wages and salaries reduction, whether it's going to be one-off, whether it's going to be sustained, and what will be the effect. So now let's look at this. Let me see the assignment that I gave you. Where is it? Okay, let me share this one. Let me see. I want to take you through the assignment. Okay, let me see. Any question whilst I look for? Okay, so it's here. That's good. Okay. So let me stop sharing this one, and then I take you through the assignment. Share screen.
Hello.
Hello, sir.
Yes, I'm listening. I'm listening.
Doc, please, do you have similar slides like this for other topics?
The other topics. Which one? Like the maths that we're doing.
Yes, demand and supply,
No,
production theory, cost theory.
no, I have the book, and I don't have. That's why I'm writing to give you and I always try to give you the notes. But I've given you the books, but I don't have slides. Okay, so let's proceed. So
Hello.
this, yes, I can hear you.
Like what he was saying, some of us join late. Like we get more understanding when we get the slides with the recorded one. So I don't know if the first 2 to 3 lecture that we had, if there's something of that, so that can be shared to some of us who joined the class late.
It's a problem, we've always been mentioning, especially for my course. I have a folder where you have everything. Right from the course outline, and let me show you. And I've shared everything with you to the last lecture. All the lectures also do the same. So when you just go to that particular folder, in the one we share, the Google Share Drive, you will find all the slides, all the notes that I use. And I share this with you almost all the time. I compile it and then I share with you almost all the time. Let me show you this. Let me just show you this one so that you don't lag behind.
Okay, sir.
You don't lag behind. Okay. You can see my screen.
Yes, sir.
Okay, so this is that folder. You have this, all of you. It's always been shared in your WhatsApp platform. So this is that folder that I'm opening.
So this folder usually has an expiring date and time.
No, it doesn't. This is the one that has the expiring date is the we transfer, the one that I use to share the recordings in bulk. This one doesn't. Okay. So this is the one that we always share with you.
Yeah, sir, can you reshare it? Because as we joined the
okay, no problem. I will reshare. So okay, when you can see all the course materials here, have you seen?
Yes, sir. Yes, sir.
And you can see business economics, the third one.
Yeah.
So when you go here, you also see the business economics. You click here. Okay, and sir. Here you have the economics textbooks, as you can see. You also have the course outline, and you also have the what? The lecture notes.
Yes, sir.
So if you click the lecture notes, you will find all of my lectures. Have you found?
Yes,
You can see
sir.
lecture 1, lecture 2, lecture 3, lecture 4, lecture 5, lecture 6, lecture 7, and today is lecture 8, which I will also add.
Okay, sir.
When you go to
if you could reshare them for us. So
this is also the course outline.
Okay, sir.
This is also the books that we are using. Remember, I gave you these books. Yeah. So when you go to this, you just go here and download. You just go and download all the files. In fact, for all the lectures, no, these are my personal stuff.
Okay.
So you can go and download everything there.
Okay, so you send it to us so I will go and do the downloading.
Okay, that's good. Thank you. Okay, so back to the question. So this is the assignment. So the assignment, we are saying Ghana has gone to the IMF with the hope of reviving the economy for the blah, 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 blah. The finance minister prepared the Nkonim budget. And you know the last budget was called Nkonim budget. I think that was his last budget he read before exiting. And it is under the theme pursuing growth and development within the stable macroeconomic environment. So you are part of the consultants selected to advise the fiscal situation of Ghana and to assess the credibility of the budget as the country is under the IMF program, or to assess the fiscal credibility of the budget as the country is under the IMF program. Okay. The summary budget data are provided below. So I took this data from the budget. So we have the revenue side and we have the expenditure side. So all these are the what? The above the line what items. So 2023, this was the budget projection. And you see the overall revenue, 134.9 billion. And then 2024, government is saying, I'm going to increase the tax revenue to what? 100 and what? 6.4 billion. And the tax revenue, listen, this is total revenue. The tax revenue is what? 108 billion for 2023. And then 2024, the tax revenue is what? 104 billion, 143 billion. And then government social contributions, other revenue and grants like government getting, dividends from maybe each share in Anglophone, Ashanti, Cocoa Board or whatever, that government also is a shareholder. That gives the revenue or dividend to the government. And on the expenditure side, we are looking at what? Compensation of employees, that's the wages and salaries. We have 51 billion 2023, 2024 is what? 63.6 billion. Government consumption expenditure, that is the use of goods and services here, 8.6 billion, 11 billion. Interest payments and the rest. So you can even see the various discretionary and non-discretionary items. And you find the overall balance. And the overall balance is the fiscal deficit, which is what? Revenue minus what? Expenditure. So you can see revenue is 100 in 2023, 100 and what? 34.5 billion and 0.9 billion against expenditure of what? 189.8.9 billion. So clearly it's going to be a negative, which is what? As a share of GDP is negative 5.7. And then in 2024, it is also a negative what? Balance. That is the fiscal deficit. However, the fiscal deficit, government is saying it will be lower than before. Okay, as you will see, 4.8 being lower than 5.7, even though it may not be true because 2024 is an election year. So election years, government overspend. So they can even spend more than 5% of the fiscal deficit that they are projecting. So I will not be surprised if the next budget government comes and tell us that even though we projected 4.8 fiscal deficit, but we ended up spending more and then spending the maybe say 10 point something fiscal deficit. It always happens in election year. So we find a nominal GDP in billions, 8.854.8 and then 1.05 trillions. Okay. So we have all the terms here. I just summarize it. So now the question is, and like I mentioned, you can see the source, and I've also provided the page numbers where you can find this in the budget. Now you can look at it from this perspective of analyzing you as an economic consultant to do the analysis. The historical tax buoyancies for 2022 and 2023, which means that we've given you the tax buoyancy for 2022 and in fact 2023, and we've estimated it to be what? 1.44 for 2022 and 1.29 for 2023. So now, based on the tax buoyancy implicit in the what? In the 2024 budget, and given the ongoing fiscal constraint of Ghana with regard to revenue mobilization from domestic and foreign sources, what questions will you ask the government to assess the credibility of the 2024 budget projection? Now, here we are saying that given the ongoing fiscal constraint of Ghana, fiscal constraint means you are struggling to mobilize revenue, okay, or you are struggling to control expenditure. So by saying fiscal constraint or fiscal policy, like I mentioned, issues on revenue, issues on expenditure. But here we are being specific. If I can say fiscal constraint, it means that government struggles from the revenue side. In other words, government struggles to mobilize revenue. It can also be government struggle to control its expenditure. So here, I'm being specific, given the fiscal constraint of Ghana with respect to revenue mobilization, from which sources? From domestic and foreign sources. What key questions will be asking government to assess the credibility of the budget? So let's look at the revenue. Government is saying that I'm going to increase revenue, total revenue, from 134.9 billion Ghana cedis to 176.4 billion Ghana cedis. So we will be happy, but you need to assess the, the credibility of this, because we know it is difficult to raise revenue domestically. Domestically, government cannot increase taxes wherever we won't pay into your e-levy. I know a lot of people deactivated their mobile money because they don't want to pay e-levy, whatever. You know the challenges. Government cannot also impose, any meaningful additional taxes because we are already overtaxed, okay, and overburdened. But we are projecting to increase total revenue from 134.9 billion to 176 billion. In fact, the focus should always be on the tax revenue. And when you look at the tax revenue, look at how much the government is projecting to receive in tax revenue alone, from 108 billion to 143 billion. But government recognizes the challenges. It can mobilize revenue domestically. It cannot also mobilize revenue externally. In fact, in terms of borrowing, no one would want to borrow to us again until our fiscal situation improves. So how are we sure that this revenue projection that you are giving us is true? One, you need to calculate the tax buoyancy. So how do we calculate the tax buoyancy? So your answer to your question, you need to calculate the tax buoyancy. And the tax buoyancy is what? The percentage change in your tax revenue. Please note, the percentage change in your tax revenue all over the percentage change. Please note, all over the percentage change in the nominal GDP. All over the percentage. Okay, let me just say the percentage change in GDP. The percentage change in GDP. And you know for sure that percentage change in, let me go down, tax buoyancy. So I'm just answering your assignment question like that, which will also be coming in the exams. Tax buoyancy is equal to percentage change in tax revenue all over percentage change in what? In nominal GDP. And what is the percentage change in tax revenue? Percentage change in tax revenue, which I will write as this one, is equal to what? It's equal to the tax revenue for 2024. Is that not it? That's the one new one, minus the tax revenue for the previous year, 2023. Okay, all over the GDP for 2024 minus the GDP for 2023 times, remember, 100 times 100. So this is the what? This is the value that we are going to, when you plug it in, that is what you are going to get. So please note, the tax revenue for 2024 is what? Tax revenue for 2024. Remember, it is not the total revenue. The focus is on the tax revenue. So when you even look at how much government is going to get from tax revenue, the share out of 134 billion, government is taking 108 billion from tax alone. In 2024, out of 176 billion, government is taking 143 billion from taxes alone. So tax revenue for 2024 is 43.2 billion. You don't need to write everything. So it's just 142 billion. So we have 143. 143.2 billion minus the previous one. The previous one is what? I've muted him. So the previous tax is what? The previous tax revenue is what?
108.
108. So 108. Point what?
we have to go up.
Okay, so you can just go to the, what is the name, the question. I don't want to.
Yeah.
Okay. The previous question. Look at what time is here. 108.5. As you can see, can you see it here?
Yeah.
108.5. 108.5. All over the GDP for 2024. The GDP for 2024 is what? When you go down, you will see it. Nominal GDP is also in billions, right? So this one will be what? 85. This is the old one. For 2020.
Hello, Doc. Please, the formula. I think the percentage change in total revenue, wouldn't it be over? That's the 2024 minus 2023
it's true.
over.
In fact, you are correct. You are correct. This one minus here. Here will be minus the what? The old one. Are we together? Are we together?
Can you go on this side? Why is it the other way out?
Oh, yeah. Remember, even in demand and supply.
Yeah.
Even in demand, so if you want to know the percentage change in total.
Okay, yeah.
So it will be the new one minus the old one divided by what? The old one times 100. Thank you very much. So here will be what? 108.5 times what? Times 100. So what will you get? So what will you get? So we are going to have 143.2 minus what? 143.2 minus 108.5. Is that not it? Divided by 108.5 times 100. Here you will get 31.98. 98%. Good. So we do the same thing for percentage change in what? The GDP. So we do the same thing for the percentage change in GDP. That is for which one? The second one, the denominator. So this will also be the GDP for 2024 minus the GDP for what? For 2023. All over the GDP for 20 times what? Times 100. So here is what? 10 from the question.
1050.
Is here.
1050.
Point what? 0.9. Is that not
997.
So 1050.9. 1050.9. Minus this one, the
854.
854.
0.9.
0.9. Okay. So divided by 854.9 times 100. So what will you get? 1050.9 minus 854.9 divided by 854.9 times 100. We are going to get 22.93%. That is good. So here, our tax buoyancy. So you can see our tax buoyancy will be what? Percentage change in what? In tax revenue. All over.
Percentage change in the GDP.
In GDP.
Yeah.
Good. So the percentage change in tax revenue was what?
31.98%.
31.98% all over this one. Percentage change in what?
22.93.
22.93%. So what will you get?
1.4.
1 point what?
1.4 tax buoyancy.
So 1.4. So that's the tax buoyancy. That is good. So this is the tax buoyancy. I will just write TB. For which year? For 2024. Which is what? 1.4. Is that not it?
Yes, sir.
Good. So now let's compare with the previous tax buoyancies. So we have the tax buoyancy for 2023, tax buoyancy for 2022. 2023 was what? Remember from the question. The historical tax buoyancy for 2022 and 2023 have been estimated at what? 1.44. Is that not it?
Yes, 1.44 and 1.29.
So
yes,
1.44 and
1.44
so 1.
for 2022.
1.44 and
1.29.
And now the current tax buoyancy is what?
It's 1.4.
It's 1.4. So when you compare this current tax buoyancy of 1.4 to the previous, it's within range. As you can see, they are closer. And even though government is projecting a higher tax buoyancy than before, but it's not significantly different from the normal trend. Are we together?
Yes, sir.
Yes.
So in terms of the revenue projections based on the tax buoyancy, it might be credible.
Okay.
But we don't assess the budget only based on that. Are we together?
Yes, sir.
But you will realize that 2024 tax buoyancy, are we together?
Yes, sir.
Is higher than 2023 tax buoyancy. Tax buoyancy for 2024 is greater than tax buoyancy for 2023. It's the same thing. You have to ask the government, how is he going? And by higher tax buoyancy, it means most likely higher tax revenue. So how is the government going to increase the tax revenue? What are the key questions? Will government be introducing new taxes? So you ask the government, will you be introducing new taxes? If yes, what are those taxes? If government is not going to introduce new taxes, now will you be increasing the tax rates? If yes, will it be the direct tax rates like the income tax that we pay, or the indirect? If it's indirect, which goes so that we will be able to assess those tax rates and see its impact on the taxpayers. So even though please let me learn, even though the tax buoyancy is not significantly different from the normal trend, but it is higher from the previous years. So you need to ask government those questions. How government is going to increase the tax revenue. Now, would you be using your digitalization drive to plug in revenue loopholes, reducing the physical contacts in terms of revenue collection to be able to plug it to eliminate corruption in revenue collection process? So those are the key questions that you should be asking the government to assess the credibility of this particular, budget that we are looking at. Any question? Because when you look at
Doc.
Okay, yes, I'm listening.
Please, Doc, you said tax buoyancies in 2024 is greater than tax buoyancies in 2023. And when you look at tax buoyancies in 2024, it's 1.4. And that of 2023 is 1.29. So I'm confused as to how 1.4 will be greater than 1.29.
Okay, so you don't know, remember 1.4 is the same thing as 1.40. And here it's 1.29. So even if you knock out this one, you are left with 40 and 29. Which one is greater than the other?
Oh, okay. 40 is greater than 29.
Okay.
Thank you.
Okay, so Doc.
Yes.
Hello, Doc.
Yes, I'm listening.
Yeah, sometimes the less than and greater than symbols are confusing. So expressing them in the real world terms, is it permissible?
Oh no, you can express in real terms. Yes, you can. 2024 is less. Just that you are wasting your time, but you can do it, and I will encourage you to do it. So in the exams, please note, in the exam you don't have to write the whole figure. The figures are huge, but you don't have to write the whole figure. But you need to know that if you are expressing, if you cannot convert, then just write the whole figure. Are we together? If you write the whole figure, you are going to get the same. So here, even though your tax buoyancy is not outside the norm, it is higher than last year's one. So you have to tell us how you are going to mobilize those additional revenue. Will you be increasing taxes? And if yes, what are the new taxes? Which areas, which sectors of the economy will you be introducing taxes? Is it the mining sector, in the direct taxes, indirect taxes? Will you be using digitalization? Is e-levy that you are venturing your hopes on? Are you getting it? So these are some of the questions that you should be asking the government to answer.
So, Doc, as part of our answers, are we going to provide those questions?
Oh, yes.
Looking at
in fact, the question is asking you to ask those questions. What questions would you ask the government to assess the credibility of the projections?
So, okay.
Are we getting it? Okay. So now
Is there a number of questions that we have to ask?
And I've given you those questions. In the slides, they were there. Yeah.
Okay.
So based on what you are finding.
Hello, Doc.
So will you be using your digitalization drive to plug in loopholes? Will you be working on our tax moral so that we don't evade taxes? Will you be introducing the taxes? Will you be broadening the tax net? If yes, which sectors? If you are introducing new taxes, which taxes will you be introducing? If you are not introducing new taxes, but you are going to raise taxes, which sectors will you be raising it? Indirect taxes or direct taxes? If it's direct, is it going to be cut across, or it will be based on the high income earners? If it's indirect, which sectors is going to increase cement taxes on cement, taxes on pure water, taxes on whatever, taxes on import duties? How is the government going to raise those particular taxes? Okay.
Hello, Doc.
Yes, please go ahead.
Doc, please, can you be charitable to us in the examination? Why am I saying this? Because some of us are babies in economics. This has been the first time of some of us being in economic class. And I must say today's lectures has been enlightening. Always people are making arguments on media with regards to budget and other things. Today I've gotten a lot, but I will please with you to be charitable to us in framing your questions in an examination, because some of us will be a little bit confused.
Okay, no problem.
Thank you very much.
Thank you very much. I'm grateful. Thank you. Okay.
Hello,
so now
Doc.
let's proceed. Yes.
So I think a follow-up question on what my dear brother is saying. Looking at the first question that he even gave it to us, I think you expanded it during the wage determination and those stuff. But I would have been much happier if you'd have used figures in explaining your point. Because assuming I have the first question will even with regards to the assignment. Because if for example, the government, as per the budget for 2024, government has to raise the equilibrium wage by 13%. Earlier on, somebody made asked a question that in this case, where should we put this 13 of? Must he add the 13 to the new equilibrium rate, old equilibrium wage to get a new equilibrium rate, or where must the 13?
We are increasing it by 13%, which means the current one plus this new one. So it will be the previous equilibrium wage plus the 13.
God bless you. You've answered me right.
So otherwise, I could have said if government has raised the equilibrium wage to 48. I think the answer is 48 or so. I don't know, but it's 40 something.
Yeah, say 49. 49. Yeah.
Okay.
Thank you, Doc. Because some of them, some of us have not done economics before. So sometimes it becomes an argument, especially if it is a group work. So if you are putting the right answer there, another colleague will also say, no, it's not like that. So if we solve many questions of that nature, it becomes very clear to us.
But why do you want me to be asking those simple ones?
No, just like similar questions and to just help our brothers and other sisters that have not even done economics. Yes, sir.
Okay, that's fine. Thank you. So the B part is as part of the IMF condition. So have they organized and sent you to ask me those things? They are bribing. Okay.
No.
So
Dog.
those who haven't done economy, how are you coping?
Dog, we are managing.
So we are not managing. Actually, those of us who haven't done economics,
it's true. We are not
finding
managing
it very
at all.
difficult.
We are finding it very difficult.
We wish some of the question will be theory instead of calculation.
Look, the most difficult part is the beta and the alpha part.
And which will be coming? Yeah, which will be coming? Yeah, please go ahead.
If you can be charitable enough to give us some sample questions.
Oh, but I've always been giving you questions. I tell you, this question is coming. This question is coming.
Dog.
Like the assignment question, all the choose two questions are coming in the exam.
Dog. Hello, dog.
Okay, someone has raised their hand. Solomon, please go ahead.
Dog, please, sir. Will you be charitable enough?
Okay, go ahead. Go ahead.
Yeah, I'm saying it. Yeah, for the sake of those of us who have no economic background, can we have more questions on theory? In the exams.
Today's lecture, we have some questions in theory, but majority will be calculation. Economists at the advanced level after SS is not theory, it's maths. That's why if you don't know maths, don't
complete the question and then maybe
I think we should proceed. Yes, last person, Solomon, please go ahead. Solomon. Solomon, your hand is raised. Okay, let me.
Hello, Doc.
Unmute
yourself. Let's proceed. Hello, Doc.
Okay, yes, Yusuf.
Yes, I want to plead with my friends. You say you accepted, you've heard everything. So why do you continue to ask certain things? So please, let us continue. He said he has heard those of us who have not done economics. So let us continue. He knows how to put it. But if we continue to demand certain things, it's going to have a lot of challenges.
And we are even lacking behind.
Thank you very much. Okay, thank you, sir.
So the B part is saying, as part of the IMF conditions, remember Ghana is under IMF program and we have what conditions to meet. So as part of the IMF conditions, Ghana is to adopt a less expansionary fiscal stance. What numbers on the expenditure side of the budget for 2024 raise serious questions regarding the extent to which the country respects this condition? Elucidate. What am I asking? The question is, Ghana is under IMF program. And with the IMF program, it is telling Ghana to be less expansionary in its fiscal stance. What does that mean? It is telling Ghana to adopt a less expansionary fiscal stance. By telling you to adopt a less expansionary fiscal stance, it means you should reduce your expenditure. Remember, I said fiscal stance or fiscal policy is looking at what? Revenue side and expenditure side. So here, by being less expansionary, it means that you shouldn't expand your expenditure. Okay, you shouldn't expand your expenditure. So it means that government is telling, IMF is telling Ghana not to be fiscally irresponsible. Government is supposed to reduce its expenditure. That is what IMF condition is saying. You should reduce your expenditure. So if the government is telling you, if IMF is telling you to reduce your expenditure as part of the conditions, now to what extent is the country or is government respecting that particular condition? So in this particular question, you are going to look at what the expenditure side, because it is saying that what numbers on the expenditure side of the budget for 2024 will raise serious questions regarding the extent to which the government respects this condition. And what is this condition? You should adopt a less expansionary fiscal stance. So let's go to the expenditure side. And by adopting a less expansionary fiscal stance, it means that you should reduce your expenditure. So let's go to the expenditure side. You can see from the expenditure side, let's go by one. In fact, the overall expenditure was 189 billion in 2023. In 2024, it increased to 138.3 billion, as you can see. Now let's go granularly. Now, to do granularity analysis, it means that to look at the expenditure one by one. Now let's look at compensation of employees. By being less expansionary, it means that you should reduce the expenditure on what wages, compensation of employees. 2023, it was what, 51.3 billion. 2024, 63.7 billion, as you can see, or 63.6 billion. Now, for the first one, for the first expenditure, is government respecting the IMF condition? Remember, it's telling the government to reduce expenditure. So the first one, is government respecting the IMF condition here?
No.
So let's go to the goods and services. From 8.5 to 11, is government respecting the IMF condition here too?
No.
Interest payments, which is even non-discretionary. Government cannot, remember we mentioned it, interest is non-discretionary, so government cannot even talk about reducing the expenditure on it. So we expect it to be higher, as you can see. Subsidies. Government is not doing planting for food and jobs. It's telling government to reduce expenditure on food for jobs, those subsidies that they provide to farmers and any other agent. We can see it's even higher, from 350 million to 426. Is government respecting the condition here?
No.
Social benefits, free senior high school, and what have you. Is government respecting the condition here?
No.
Which means that on all the expenditure lines, government is not respecting the IMF condition of what? Being less expansionary. Are we together?
Others is less.
Excellent.
Yes.
Apart from what? The other expenditure, which is relatively lower than the previous budget. Are you getting it? Others, which is relatively lower than the previous budget. So you can see those items that almost all the expenditure items government have rather adopted a more expansionary fiscal stance relative to the condition of you being less expansionary. So government intrinsically and by far, government is not respecting that IMF condition of being less expansionary in terms of expenses. Are we together? Okay. So the C part is, in your own, opinion, to what extent?
Hello, doctor.
Yes.
Hello, doc. Well, thank you very much. Before we advance, I wanted to find out, could there be a twist where maybe your question would deviate from less expansionary fiscal stance? Could there be a reverse of that question so that we can? Okay.
And what would be more expansionary fiscal stance? And by being more expansionary fiscal stance means what? Spending more. So spending more than before. So government stance at the moment 51 to 63. Is it more or less?
It's more.
It's more expansionary. The second one to more expansionary. Third one more expansionary. So for all the major expenditure lines, government is rather more expansionary than less expansionary.
Okay.
Are we together?
Okay. Yes, thank you.
So government by far is not really respecting the IMF,